Welcome back to the Money Pig Podcast, brought to you by Goodwin Investment Advisory, where our mission is to lead people to financial peace, independence, and generosity. I'm your host, Reed Trigo, and today on the show, we're joined by CFP Justin Pitcock for a discussion about GIA's end-of-year planning guide. Justin, it's great to have you back.
Man, I always enjoy it.
And you're good at it, so this is good.
Questionable.
Yeah, well, you are, and we're going to make people smarter here today, which is always a great goal. So we put out these guides, or in some cases they're checklists, but guides for our clients. And we have a whole bunch on our website. You can go to goodwininvestment.com, search our guides. And this is one you can find. It's the end of year. End of year could be one word too. We could do that.
We can write it however we want to.
The end of year planning guide. And what we do is we make end of year planning very simple, break it down into basically 4 categories. And I thought you would be great to come on and talk about this.
Sure.
Yeah, because you do this all year, but a lot of people, it kind of gets high on their list to do an annual meeting.
So yeah, every year we try to have an annual meeting with each of our clients where, we sit down or have a virtual meeting. I'd prefer to sit down in person, but nowadays a lot of folks are busy, and so virtual is so much easier. But we want to cover some main areas, investment planning, tax planning, retirement planning, estate planning, and hit at least at a high level each of these areas to make sure that nothing has changed.
I love it. And so some of these are more interesting than others. I'm just going to say, because I'm a normal person, are
you sure about that?
Yeah, well, not in all ways, but in this way I am. So I think we've kind of arranged these in maybe order of interest. Okay, we're going to hit a high point first and a high point last, and we're going to couch the boring ones in the middle.
Sounds good.
Maybe it's my perspective. I'm sure there are people who find estate and disability planning to be enthralling. I'm just not one. So,
me neither.
Let's start with this. This is a high interest, pique your interest topic. Tax planning.
Yes, that's my favorite topic.
Oh, man, it's my kryptonite.
So, we're getting close to year end. There's not a lot you can do if you wait past December 31st. Hopefully you've been tax planning all year, but now that we're getting to the end of the year, okay, it's typically open enrollment season, November, December. At least make sure, maybe this should be, instead of year-end planning, it's year beginning planning.
Oh,
but,
yeah.
So for your employee benefits, make sure you're capturing all those benefits that you can, because they're really designed to help you pay less in taxes. If you can max out that HSA, HSA is not use it or lose it. The FSA is. So if you only have access to the FSA, be mindful of that. If you have the HSA, you can max that sucker out.
And just to say, FSA, flexible spending account, you can use it toward health and medical expenses.
Health, yep, wellness.
Yep. And then HSA is a health savings account, which is a deductible contribution that is tax-free if you spend it on your health, medical, and wellness expenses.
Right.
And is invested and can grow. And
it's investable and it stays with you. And actually, you don't even have to have an HSA through your employer. You can open up an HSA on your own, but you have to be enrolled in a high deductible health plan.
That's right.
That's the one criteria. As long as you're enrolled in a high deductible health plan, you can contribute to an HSA. Guess what? If you're not working, your spouse isn't working, and you have money in a savings or a brokerage account, you can still contribute to an HSA. It's not like an IRA or a Roth. You don't have to have earned income to contribute to an HSA. You only have to be covered under a high deductible health plan.
Love it.
So max that sucker out if you can. You still have time.
Good.
So aside from, maximizing your employee benefits, if you're signed up and you've got health insurance through the marketplace and you're on an Obamacare plan, it's income based. And when you signed up for it, you entered in an estimate for what you thought your income would be this year. It's a good time in the year to check. Are you about in that same area? Are you over? Are you under? And are there things that we can do? So for example, if you've realized capital gains with your investments this year, we might be able to realize capital losses to offset capital gains to keep your subsidy as high as it can possibly be for that Obamacare health insurance. So I mean, that's just an example of one thing we can do. Or maybe it's, okay, can you push out realizing income? Maybe your advisor wants you to rebalance your portfolio and realize cap gains. Can we do that? Some of that next year? If we're on an Obamacare health plan, we need to be very sensitive to what your income is. And okay, maybe there's nothing you can do, but you can at least prepare for owing a little bit of money after you file your taxes.
And I have lived through this for so many years, and it's such a pain in the neck. But you know what I think about? I think about people who might be on like a set it and forget it investment plan or retirement plan. They're like, I don't have any capital gains. I didn't sell any stock this year, but look at me. I'm going to weave into this other category of investment planning because one of our items here is to understand the tax implications of any mutual fund capital gains distribution. So you may not have actually sold any stocks, but your mutual fund may have had some capital gains that you may not know about. So you'd want to talk to your investment advisor about it.
Exactly. That's a great point, Reed, because a lot of times you think about, well, I didn't sell anything. But if you're invested in mutual funds in a taxable account, guess what? Underneath the hood, that mutual fund could have sold stock. And typically around the middle of December, they send out their capital gains distributions, and you may be stuck paying on taxes or stuck paying tax on gains that you didn't actually realize.
You may have just bought that mutual fund last month.
Yeah, a few days ahead of a few days before. So be very sensitive to that. And that's why in our managed accounts, the taxable accounts especially, we're primarily using ETFs instead of mutual funds.
That's right.
Because ETFs are a much more tax-efficient investment structure than a mutual fund. So there are some other items here. So charitable is a big tax savings area. Obviously, if you're charitably inclined, donating to a charity can help reduce your tax, but it may not be to the extent that you think. So it's important to know the way that the tax system works. There's really three main deduction categories. So there's mortgage interest, there's state and local tax, and there's charity. It's kind of just those three categories for below the line deductions. And it's the greater of the standard deduction or the sum of your itemized deductions. And if your itemized deductions aren't more than the standard, then there's no economic benefit to having those itemized deductions. So if you're giving just for the charity write-off, well, it's not going to be dollar for dollar, and it may not have an economic benefit at all. But give because you want to, good because it makes you feel better.
Right. Rejoice in the fact that you're actually helping someone, whether you get the tax benefit or not.
So, but there's a way that you can bring forward giving. So let's say you're really close to reaching the standard deduction. You're charitably inclined. You want to give away some money. How much more money do you need to give before there's an economic benefit? And do you plan on giving away money next year? Maybe we can bring forward that giving, put it in a donor advised fund where you get the charitable deduction this year, and that extra giving that you're going to give next year is all deductible this year. However, it goes to a donor advised fund, or now you can send it out of that donor advised fund on whatever time frame that you want. Maybe you send it out monthly next year like you're going to anyway.
And the donor advised fund can be invested. So you can actually take your original contributions and they could grow over time if they grow in the stock market. Yeah.
Exactly. So think about your giving. Think about medical expenses as well. So you can bunch those. If you have the opportunity to either count a medical expense in the year that the expense was incurred or the year that you pay the expense. So if you can push out paying the expense or pay for something like you got a surgery coming up in January, you want to go ahead and make a payment on that, I'm sure the hospital will let you do that. You can go ahead and get that deductible. But remember, there's a 7.5% threshold. You have to have spent over 7.5% of your adjusted gross income before medical expenses are deductible. And that's an above the line deduction. That's why I didn't mention earlier in below the line deduction. So there's some bunching strategies there. So again, keep track of all of your medical, all of your charitable. Charitable's below the line deduction, medical's above the line. Think about, okay, the timing do I want to count this next year? Do I want to count this year? There's ways that maybe you can manipulate things and do that. And then keep track of mileage. So you can track mileage that's from driving to go volunteer or serve places. You can track mileage for medical as well, and there's a deductible rate for that. It's different than like the deductible rate if you were to, be self-employed and you're tracking your mileage for, business purposes.
Yeah, it's like half of it or something.
Oh,
like
yeah,
that.
it's less than half.
Oh, okay, there you go. So I saw this one on here. Very interesting. Small business owners, make sure you don't fall under hobby loss rules. Tell me about that.
Oh, gosh. Okay, well, you probably need to ask Krista and listen to one of those other
Actual
podcasts.
CPA.
Yes,
Okay.
but the gist of it is that if the IRS could disallow like a loss if it's considered to be a hobby. And another thing is good to know as a an entrepreneur, if you have little side hustles here and there, if you show a loss with one side hustle, okay, it can offset some income, some profit on another business, but it's not going to offset your W-2 income. So if you're working a regular W-2 job and then you go have a side hustle and you're trying to create a loss with that side hustle, it's not going to work for you. That loss could carry forward where if your side hustle eventually becomes profitable, it could offset future income, but it's not going to reduce your W-2 income.
So if your hobby never becomes profitable, it's a loss.
It's just a loss.
It's just not a tax deductible loss.
It's a loss. That's right.
Okay. Got it. Great. And then this SALT, state and local tax, something or
so
other.
Business owners, if you're an owner of a pass-through entity, you can pay your state tax through the entity. The benefit here is that it becomes
A pass-through entity is an LLC or an S corp.
Yes.
Okay.
Yes. And if you pay it through the entity, it becomes fully deductible on your personal tax return, because under the current tax law, there's a $10,000 state and local tax limit to what you can itemize on your tax return. We talked about those itemized deductions just a moment ago. Mm-hmm. Well, you're capped at $10,000 in that category. So if you owe more than $10,000 in state taxes, pay it through your business, it becomes fully deductible. You just worked around that $10,000 state and local tax cap. So for business owners, it's a great opportunity. It's not too late. Your business should be paying those taxes for you, not you personally. Also, kind of in that same vein, there's the Georgia Heart program, where you can redirect your state tax liability to go to a hospital instead of the state's general fund. And you get a dollar for dollar credit for that. And the way you do that is you go on to georgiaheart.org, you apply for the credit, the Georgia Department of Revenue approves it, then your entity gives a check to one of the hospitals on their list. And then dollar for dollar, you get the credit. The IRS can look at that, and they've got a white paper on this that kind of tells you when it's allowable and when it's not. But they look at that as goodwill, building goodwill in your community where you do business. And now that redirection of your state taxes becomes fully deductible, again, working around that $10,000 state and local tax cap.
I love it. Okay, tax planning, that category, very, very interesting.
Yes.
Okay. So hang with us, folks. We're gonna go into estate and disability planning really quick, but we're gonna come back to something more interesting here in a minute. We'll make this quick. But estate and disability planning is very, 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 very important for many people. It's just not very, 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 very interesting for a lot of people.
True. Super important.
But
so
yeah,
the best way to start this is with like a cocktail, margarita or something on Friday night. No, I'm just kidding.
Yep.
Maybe not Friday night, but it's a good idea to just review your estate docs. Has anything changed? The person you designated as, the trustee, are they still able and willing to serve in that role if something happened to you? The person that, you put in charge of your kids if something happened, are they still the right person? So it's good to read through who those designations are. Are they still relevant? Are they still willing and able to serve? Has anything changed with your situation? Maybe you had another child, or maybe your extended family grew. Maybe some of these beneficiary designations need to be updated as well. That goes, hand in hand with like life insurance policies. Obviously, want to review that, make sure the right person is getting that money there as well.
Disability insurance policies, stuff like that.
For folks that have a taxable estate, and it may not necessarily be a taxable estate right now, but if something happens to you and you have a net worth over a certain dollar amount, guess what? The government's going to tax your estate. And the way to plan for this, it takes a little bit of forethought. Okay, maybe you're not there yet. Right now it's $24 million for a couple. Okay.
So 12 million per person.
It's a little over that.
Okay.
But yep. Yeah. So if, we don't serve a lot of clients that are in that category, but there's a lot of folks, I think, that, maybe you've got a couple million right now and have a good likelihood of having, 10, 12, 14, 15 million in the future, right? And the tax code's going to sunset at the end of 2025. That $24 million estate tax threshold is going to drop down to about 14. So I think there's a lot more people in this category that are going to be affected by this if Congress doesn't change the law, which, they've got time to do, but they probably won't. So if they don't change the law or act and do anything, there's a lot of people that are going to have a taxable estate. And they need to just note, we may not be there now, but we probably will be if our investments grow, if they're invested well. And so what are some things that we can do? And one of the simplest things that somebody can do is start going ahead and giving some of that money to the next generation, teaching them about stewardship. And you can give up to $17,000 per spouse per year without reducing your lifetime estate tax exclusion. So it's 17 per spouse, 34 as a couple. If you do 34 as a couple, you actually have to file a gift tax return. It's a non-taxable return. It's just a notice filing that, hey, I gave more than $17,000 to one person. Now, to be clear, like you can give $17,000 to multiple people and not have to file a gift tax return.
Got it.
But it's if you give more than 17 to the same person, you've got to notify the IRS to let them know that you did that. And
so then do they say, okay, that's all right, but we'll just average together with future years or something like that?
So from 17 to 34, if, married filing joint, it's still it does not reduce your lifetime exclusion.
Okay, I see.
But the IRS is watching. If you're over 34, if you give over $34,000 as a couple, then it starts to reduce your lifetime exclusion by that dollar amount, the dollar amount over the 34.
Okay.
Or, if you're not married, it's anything over 17. So if you're, filing a single tax return, anything you give over $17,000 per beneficiary is going to reduce your lifetime exclusion.
Got it. And so just some random person listening to this, if they want to give me $17,000, they can do that. No gift tax, no worries.
Yeah. That's exactly.
Thank you. Yep. That's all I wanted to figure out. That's wonderful.
Making estate planning a little easier here. A little more fun.
That's what it is. Okay. Well, we did a great job there on estate planning. Also, there was one item on here, and I'm just going to say this: consider charitable giving and funding 529 plans. Contributions to, for instance, in Georgia, where we are, a Georgia 529 plan can be tax deductible.
Well, and that's a great point. It doesn't really fall necessarily in this estate and disability planning, but contributing to a 529 plan is a great way to invest in your kids' college or grandkids' college. If you're a Georgia resident and contribute to the Georgia 529 plan, that contribution can be deductible on your state tax return. It depends. Now, if you're able to itemize on your federal return, then you have to itemize on your state tax return. And if you contributed to a Georgia 529 plan as a Georgia resident, then that contribution is deductible up to $8,000. So
I don't know how you remember all this stuff.
It's a lot.
Justin, you did a great job. Thanks. If you're still here listening, we got through estate and disability planning. Now we're going to move to investment planning. This is more interesting for sure. So let's talk about some important. I already hit one of these. This understand the tax implications of mutual fund capital gains distributions, which you may not even have known you'll have. You'll just get a 1099.
That's right.
Div or whatever it is. No, what's the
just 1099?
1099. At tax time, you'd be like, "Why is Fidelity sending me a 1099?" You'd be like, "Because we sold a bunch of your mutual funds and you got all these capital gains." Like, thanks for telling me.
Exactly. Those mutual funds can sell stuff and you don't know it because it's underneath the hood. You still hold the mutual fund, but they sold some of the underlying stocks. And then normally later in or mid-December, you get this capital gains distribution, and you're like, oh man, now what?
Money. Well, now I got to do something about it.
Should have bought the ETF.
That's right. Well, I think the most important thing here is probably to schedule a meeting with your advisor, discuss your accounts and goals for 2025, discuss your distribution strategy if you're in that phase of life, or your risk tolerance if you're in that phase of life.
Right. So the biggest thing with investment planning is, has your situation changed? Have your goals changed? Has your time horizon changed? And we would want to realign investments accordingly. So, gosh, maybe it's retirement. Okay, we're retiring, this year ahead or whatever. Should we change those investments? Or maybe we need to change the distribution rate. Or, hey, we've got a new goal. We need to start saving for something new. It's a great idea to talk with your advisor about, just kind of any update to your current investment objectives. Do we need to be more conservative because you're ready, you're tired of your job, and you're ready to retire? We're going to start distributions. And then kind of this ties back into tax. But if you're retired already, let's look at those withholdings, because on the investment side, like typically we're setting up those distributions, and we're setting up the tax withholdings for our clients. Was that sufficient? So, right, we need to kind of just double check on that. If we need to tweak things, we will.
I want to say another one here that I think is interesting. It says, ensure your investments are performing enough to reach and or maintain your goals. And I think about something you told me a long time ago that really kind of struck a chord, I think, made me think more, was, hey, even if you're right on the verge of retirement, you're 60, you still have time for your investment portfolio to perform, probably 25 to 30 years.
Let's hope so.
Well, let's hope so. If all goes well,
man,
trying to live forever. So far, so good. Right. But yeah, that's a long investment horizon. So just because you retire doesn't mean you immediately go to an all bond portfolio.
No. And that's actually something we hear pretty often is, Justin, I don't have that much time left to invest more aggressively. And it's like, well, hold on, let's unpack that, because, you're 60. The average person that hires a financial advisor lives longer than the average person that doesn't, according to Fidelity.
That's correlational, not causal, just for the statistics people.
But according to a study that Fidelity put together, they found that folks that hire an advisor do live longer. And I don't remember the actual age, but it was like in the 90s.
Probably 190.
Oh, okay. Guaranteed. I'm just kidding.
Sorry, Herman. Compliance is going to get that.
They're going to veto this part. But so hopefully that's, like a 30-year goal, and we need to invest accordingly. And I think that's where a lot of folks get it wrong, that when they go into retirement, they invest too conservatively. It's a long-term goal, at least 20 years, Lord willing. But so we need to invest for growth. We got to beat inflation. We got to have enough equities enough stocks in your portfolio that they're going to outgrow inflation over that long time period. We need enough fixed income to provide stability in that time period. So there's a balance.
Dry powder.
That's right.
Maybe dry powder. Okay. That's great. I love it. Investment planning was topic number 3. Now, I think this one's super interesting. Retirement planning. Not just because we want to retire and become idle and not have purpose in our lives, but this stage of life where we can get and be like, work if you want and be independent, right? This is the retirement planning we're talking about.
Absolutely. Mm-hmm. And yeah, so retirement planning, it's knowing that you're on track to be where you want to be when you want to be there. And so for, a lot of folks, everybody starts out in the accumulation phase at one point in their life. Mm-hmm. And it's how much do I need to be contributing, right? I think Dave Ramsey, like most people that kind of follow Dave would know, Dave would always say 15%. I would agree. Unless you're much younger, like a teenager or in your early 20s, you could probably invest a little less than 15% of your income. But if you have waited till you're in your 30s or 40s, especially, gosh, you need to be saving 15%. And if you've waited till your late 40s, probably you're going to have to save a lot more than 15%. So the earlier in life that you can start, the better. And so I would take this as an opportunity is, can you increase the amount that you're contributing to your 401k maybe by 1%, or can you do that by more? Another tip that I would give to the higher income earners that will typically max out their 401k plan before year end. A lot of folks will say, I maxed out my 401k and it's only June. And it's like, well, good job, man. Well, so does your plan match your contributions on an annual basis or on a per pay period basis? And it's like, Justin, I don't know. Well, you need to find out, because if it's on a per pay period basis, you're not going to get the match you thought you were.
For July, August, September, October, November,
exactly.
And December. Yeah.
You might have put in 15% of your income, but guess what? The company didn't match at what they said they were, because you thought they were matching on an annual basis, but they're matching on a per pay period basis.
And you got to have your eyes open on that one.
Double check on that, especially for everybody that matches out your 401k before year end. Double check to see how your plan does that. If they do on a per pay period basis, they may do an annual true up, but I can tell you from experience, a lot of plans don't. So you're giving up a lot of that match.
Let me go back to one other thing too, because there's an item on here that's not in retirement planning, but it's related to what I'm going to say here and right about this. This whole, if you're not maxing out your 401k to get the whatever that maximum contribution is this year, increase it by 1%, right?
Yes.
And unnoticeable to your family budget.
Oh gosh, yeah,
and
you'll never notice.
I actually would do that. I did that when I was young, and we never noticed, right? Just put another 1% in, and I'll just change it every once in a while. I actually did it even just last year.
There we go.
Snuck right
Good job,
by.
man.
Yeah. But so that's the incremental improvement you can make. And I meet with clients sometimes, and they're sitting there going, "Yeah, I have an $8,000 car loan, or maybe more, whatever, $8,000, but I'm sitting on an emergency fund of 20." And okay, well, the interest rates were low, well, yada, yada. Maybe it is, maybe it is. It doesn't really matter. But they're like, I just don't want to part with $8,000. And I think getting rid of debt is a really important part of this fourth part of our conversation today, right?
Yes.
Retirement planning. So I would say, well, don't just part with $8,000 out of your $20,000 emergency fund. How about if you just make a $2,500 payment toward your car and see how you feel in a couple months? And if you feel like, okay, I'm still here, maybe I'll pay a little bit more, and you can get that car paid off in 3, 4, 6 months rather than 3 or 4 more years. It's
I think it's
incremental improvement that you can make.
I think that's really wise.
Yeah, it doesn't scare you.
But to get debt free, you got to feel some pain. You got to be uncomfortable, and it's like it's just hard when you're comfortable with debt, but you're not comfortable with not having that $20,000 there. But those are two of the same things. Your net worth is unchanged if you took that $8,000 and paid off the debt on the car. Your net worth did not change.
Your balance sheet literally stays the same. You just took the cash and you put it in one pocket to the other. Yeah,
that's right.
Yeah.
So I would encourage you to pay that off. But if, like Reed said, if you can't, incremental improvement.
Yep. So, little incremental improvements. Awesome.
So next probably would be max out your Roth IRAs if you can. Maybe you make too much money to be eligible to contribute. Maybe you're able to do a backdoor Roth. So that's something you could talk to your advisor about. We could certainly help with that. And by the way, you've got until April 15th to do that of the following year. It's not a December 31st deadline.
That's right, because it doesn't affect your taxes, especially on Roth, right? Or a non-deductible IRA contribution.
Exactly.
However, but a traditional IRA contribution, you have to do it either by April 15th or when you do your taxes, because it is a tax-effective event.
That's right. Yeah. That's right. The other would be, and this is a December 31st deadline, is Roth conversions. If the sweet spot most of the time is for someone who is retired but not yet started Social Security.
Okay.
So that's typically the sweet spot for Roth conversions.
Because you have low income.
And you haven't started that Social Security stream, because remember, Social Security can be either taxed or not taxed. Mm-hmm. So if you've started Social Security and you start recognizing income by doing Roth conversions, you're suddenly causing all of your Social Security, or not all of it, but up to 85% to get taxed. So we often look at the benefit of Roth conversions between early retirement and Social Security.
Just making a note for my own annual meeting.
Let's bring that up.
Yeah, we will. Oh man, that's really a good one. Okay, good.
Another.
Yep.
Well,
go ahead.
So while we're talking about Roths, if you've got kids and they have earned income and you want to help them get started early, maybe you can help them fund a Roth. And actually just did the math for one of our clients' grandkids. We were just talking about time value of money. And this guy is 21 years old and he could save $2,000 a year. Doesn't sound like a whole lot to a lot of people, and it is a whole lot to a 21-year-old. But when we looked at the math, if he earned a 10% compound average rate of return for 40 years till he's 61, almost 62, he would have $975,000 by starting with $2,000 and contributing $2,000 a year.
A year?
A year, over 40 years.
Oh my gosh.
So start early and start your kids early.
That's his contributions are 80,000, and the total value is 900 thousand. Come
it's
on,
the eighth wonder of the world? Eighth
compound
wonder
interest.
of the world. Yeah,
Yeah,
So,
that's amazing.
absolutely.
And I trust that you did the future value of money calculation correctly,
Yeah,
because you would.
absolutely.
That's awesome. All right. I saw another one here that I thought was interesting. Oh, the RMDs. You got to make sure by the end of the year you're taking any required minimum distributions on traditional IRA assets, right?
Yes.
Roth, no RMDs. Traditional, does that apply to like traditional 401k if you're taking distributions out of that too?
If you're still working, you don't have to.
Okay.
But if you've retired and whether your money's in a 401k or an IRA and your RMD age, which, gosh, is a mess right now because it could be,
That's right.
it could be 72, 73, or 75, depending on when you were born.
That's right.
And so anyways, you don't want to miss an RMD because the IRS could get half of your RMD if you missed it.
Yeah, and this is basically IRS saying, hey, you got to deduct this when you contributed this money. And so we're going to make you take it out so we get to collect taxes on that money at a certain rate. That's why they don't care about Roth, because you already paid the taxes when you contributed it. It's the deductible contributions they're more interested in getting their hands on.
Absolutely. And then this is sad, but something that we need to think about. If you've got a loved one that passed away this year and they were RMD age, you need to double check that they or the beneficiaries have taken the year of death RMD. So maybe you've got a loved one that passed away that left you some money in an IRA. If they passed away this year and they were RMD age, if you need to double check that either they took the required minimum amount or that you and the other beneficiaries have collectively taken the required minimum amount.
Oh my gosh, yeah. That is sad to think about, but important.
But it happens.
Yeah, sure does. All right. Well, any last thought?
I would say every couple of years, it's probably a good idea to log into the Social Security, SSA.gov, and review your Social Security statement. So just take a look what your benefit is, review the earnings record to make sure everything looks about right. But I would say I think that's the last thing on the list.
Hey, and read down through that statement too, because you'll see where if Congress doesn't fix something by 2034, you're only going to get 75% of your promised benefit. So if it says on there you're going to get $2,000 a month, no, you're not. You're going to get $1,500. If they don't get this fixed.
Don't scare everybody, Reed.
I'm not going to scare them. They need to save money in the Roth.
It's been around since, I think, like 1935 or something like that.
They got to fix it.
They've had to fix it several times before.
Have they really?
Yes. Oh, yeah. Yep. They always wait till the last hour. But what?
They're irresponsible.
Oh, gosh. But nobody's going to reelect a politician that doesn't fix Social Security, right? It's political suicide. They're going to fix it.
Maybe. We'll see. Gosh, we'll be around in 2034.
It's a legal Ponzi scheme where...
Oh, you can't call it that. All right. It's compliance is shutting us down right now. Hey, we want to thank Pantana Accounting and Tax and Sarah White is a state attorney. Both of these companies we have had very close relationships with, and they helped us put together this end-of-year planning guide. So we really appreciate it. You can go to our website, goodwininvestment.com, and download the end-of-year planning guide. And as financial advisors, we manage and rebalance portfolios. But the unique value is that we work to understand our clients' individual goals so we can have these types of planning conversations that are so personal and unique to each individual. Justin, it is always awesome having you here. Thanks for being with us.
It was fun, man.
It was. I have to say,
Except for estate planning.
Yes, estate planning. But we made tax planning interesting.
Yes.
I've never had that much fun talking about it before.
Well, we will next time too.
You're a superstar. Also, my Mac's running low on battery, so we're about out of here. Hey, get our end of year planning guide at our website. We put out an amazing blog about twice a month. So to get that, just text blog to 66866. Or if you want to speak to somebody directly here at GIA, go to goodwininvestment.com. And click schedule an intro call to speak to our GIA consultant. Thanks so much for being here, Justin, and thank you all for listening. Take it away, Angela.
The Money Pick podcast is hosted by Reed Trigo, a financial advisor at Goodwin Investment Advisory. This podcast is intended to share information and perspectives, but should not be interpreted as legal, financial, or tax advice. The opinions shared by participants are not necessarily endorsed by the company. Goodwin Investment Advisory is regulated by the SEC, and the company operates in compliance with applicable securities laws and regulations.